Wednesday, March 30th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at how stagflation and maybe even hyper-stagflation could be engulfing the world economy. Before I start, just wanted to give you a background on what stagflation is and when the term was actually created. Well, back in the 1970s, and the Keynesians have been in charge, unfortunately, for a very long time. They're still in charge now. They were in charge then. They didn't think that you could have rising prices, what they call inflation, and an economy that would be slowing down, where you would have unemployment. They thought that inflation was a symptom of a strong economy. And that's a total Keynesian fallacy, because inflation, of course, is the creation of money and credit out of thin air. It's dishonest money that really robs workers, pensioners, all kinds of people of the purchasing power of the currency. So how can you have a strong economy when the currency that we need to use, that we're forced to use, is losing power? So they were very shocked in the 1970s that that could happen. And they termed the phrase stagflation. In the last 30 years or so, or 25 years, the economics profession, the bankers, politicians, they've all bought into this mantra that central banks now are responsible, that governments are behaving properly fiscally, and that we have killed inflation. And stagflation became something of a dinosaur, but it's coming back in spades. And that's what we're going to look at today. And to start then, we're going to look at a signal in the bond market that people have been telegraphing, I know, for the last few weeks. And that's the inversion of the yield curve, of especially the 2-year to the 10-year US Treasury differential. How the yield curve works is that in a normal environment of healthy economic growth, low inflation, the lower yields start at the beginning of the yield curve. And the yield curve is from, let's say, 1 week to 30 years. And of course, if you lend money for a week, there's less risk there. So you can lend money at 3% for a week, but for 30 years, you lend it at 6%. So the curve is always up, not always, but normally upward sloping. And when the curve inverts, it means that the short-term rates become higher than the long-term rates. And why does that happen? Well, because the bond market investors are actually concerned about rising prices or inflation. So, and they think that the economy as well is going to slow down in the future. So they sell off the short-term paper, and that drives their yields up. And they do sell off the longer-term paper, but not as bad, because, for example, the 10-year yield this year is gone from 1.5% at the beginning of the year to 2.5% up until recently. It has come off a little bit. But the 2-year and the shorter term rates, they go up quicker. It's basically telegraphing as well that the central banks are behind the curve and they need to move quickly to raise their rates. And it usually forecasts a recession. And it's not just me telling that. And I'm going to show you an article here before I tell you why, in my opinion, it forecasts a recession. Well, because the banking system, which is the credit engine of this fiat currency Ponzi scheme economies that we live in since 1971, financialized economies. So normally they borrow, let's say, for a week at 2%, and they lend at, let's say, 3% for 5 years or 10 years. So they make that spread, and that raises their profitability. They leverage it, of course, the fractional reserve banking system, and that allows them to lend more freely to the whole economy. But when that reverses, when they can't borrow cheaply in the short term and lend out uh, more expensive in the long term, their profitability falls. And that's why it is very important for us to keep an eye on banking stocks right now. They have outperformed the general market, but it's something that we need to keep an eye on. So I want to share a story that's just come out uh, this morning in the FT. And I noticed yesterday, I was following the bond market quite closely. And it did invert very briefly and not for very long, but the trend is for inversion. So there you go. US yield curve inverts and possible recession signal. Yes, the mainstream always tries to deny these things. The curve last inverted, as you can see here, in August 2019. At the time, I remember people were saying, oh, this time it's different. There's not going to be a recession. And lo and behold, in 2020, we had a recession. You might want to say that it was because of COVID, but it happened. So 2-year Treasury yields rise above those of the 10-year for the first time since August 2019. Quickly go through this. A closely watched recession signal flashed red on Tuesday as investors fretted that the Federal Reserve's efforts to tame inflation will bring about a sharp slowdown in U.S. economic activity. 2-year Treasury note yields rose above those of the 10-year future for the first time since August 2019, inverting a portion of the yield curve monitored closely by Wall Street and policymakers. Inversions typically signal malaise about the economy's long-term growth prospects and have preceded every US recession in the past 50 years. Interesting that it's been in the fiat currency era, 50 years. Well, 1971, that was when Nixon took the dollar off the gold anchor. Typically, a recession has followed in 2 years after an inversion of this measure of the yield curve. 2-year yields, which move with interest rate expectations, rose as high as 2.45%, the highest level since March 2019. The 2-year yield has risen 1.64 percentage points this year as the US central bank has tightened monetary policy, including its first rate rise since 2018 in order to combat inflation that's at a 40-year high. So you see here that the 2-year is risen by 1.64 percentage points, or 164 basis points this year, while actually the 10-year is risen about 138, or how much, or 78, sorry, because we started the year at 1.5. So you can see that a 2-year has risen a lot more. And so what does stagflation have to do with this, or even hyperstagflation? Well, because stagflation is when the economy is moribund or in a recession, and you have what they call high inflation. I prefer to call it rising prices, because we need to understand, and I've said this many times, that inflation is not the CPI. Inflation is what Felix Sommeray said many years ago, and I'm going to share this. This is my profile, banner for my Twitter, because I think it's really important that people know what inflation really is. And I'm going to put a link to The Raven of Zurich, his autobiography, below in the description. It's a great book. So he said, the state alone is responsible for inflation, Inflation without government and add the central bank to that, or indeed against government, is impossible. So we've had this fallacy that central banks have been independent for 25, 30 years, that they act in the interest of the monetary system of the currency, but they haven't. They've been working with government, and that's the biggest fallacy and the biggest misconception I think we have. And why am I showing you this? Well, because you're gonna hear from a lot of people, especially central bankers, um, and especially with what's happening now, they're going to blame everything from COVID, from supply chain to Ukraine to Putin for inflation, or for the debasement of the currency that they're supposed to protect. You need to think of what we're seeing now, not as prices rising, but your currencies falling. So here we have a central banker, governor of the Bank of England, Andrew Bailey, BOE governor warns of a historic shock to real incomes as stagflation slams British economy. It's going to slam the whole world. So what does it say here? As the Bank of England scrambles to try to tame inflation, you see, they can't tame inflation. They won't be able to do it because it's the creation of money and credit. And the system is so leveraged right now. If they raise rates to unwind their balance sheets, to, how can I say, stop the creation of money and credit out of thin air, they're going to bring the whole economy down. It's going to be even worse. So, and I think that's what's going to happen. They're going to try, and what we're going to get is hyper stagflation, which I don't think, I guess the last time that happened was in 1923 in Germany. And most people think that you get inflation because, especially the Keynesians, you get inflation because the economy is strong. But no, stagflation, as you can see, weak economy, currency getting debased. And you're going to hear in the mainstream media, mainstream economists, by the bankers, they're going to blame every one and everything else but themselves. And with that, I'm going to show you proof that it's the central banks and governments. They're the ones to blame. They've been trying to keep this stock market bubble, bond bubble going ever since the '08 crisis, real estate bubble. So I'm going to share with you this report. It comes out monthly. It's free. You can go into yardeni.com and find this. This was published yesterday, March 29th. Central banks monthly balance sheets. So why are the balance sheets so important? Well, when the central banks create money out of thin air and credit out of thin air, it goes into their balance sheet. The assets that they buy with the funny money goes into their balance sheet. So if their balance sheets are growing, it means that they're inflating. And why are they doing that? Well, they're doing that to keep interest rates low by buying government bonds. And when you keep interest rates low, you keep the discount rate low and you keep the stock market elevated. So you can see here the major central banks' total assets. The winner here is the ECB with almost 10 trillion, and this is in dollars. Then you get the Fed with 9 trillion. You get the BOJ with over 100% of GDP at 6.5 trillion. And then the People's Bank of China around the same level as the BOJ. But this is what I really wanted to show you. You see, back before the '08 crisis, all these major central banks had $5 trillion in assets. And now we're up almost at 32 trillion roughly, or 31.5 trillion, as you can see. So this is why prices are rising. This is why the cost of living is rising. This is why the whole supply chain and commodity sector has been disrupted because they've stuffed the world with this funny money. A 600% growth from 5 trillion to 31.5 trillion. So now they have a problem because they've lost control of prices. They've lost control of the game of fooling people into thinking that their currency is worth something. And yes, and that's why I've been warning people, well, since 2015, late 2015, when I started this channel, that we're going to have inflation or rising prices eventually, because it's not just since 08 that the central banks have been inflating out of thin air massively. It's since 1971 when Nixon took the world off a gold standard, and there's no anchor. But yes, this is a culmination of things, and I really think we're going to see hyper stagflation, so hyperinflation for that matter. So now we're going to look at where the markets are this morning. I'm a little later today, but it's not a problem. It's around quarter to 9 a.m. London time. So gold yesterday had a pretty wild day. It did rebound back above 1900. Right now we're up just under $2 at 1921. Range has been 1915 to 1928. So I continue to stress that I'm not getting rid of my gold and silver. If anything, I'm trying to stack as much as possible, because the monetary chaos coming our way, it's even difficult to forecast what it's going to be like, but because it's never happened before, but it's not going to be pretty. What about silver? Well, silver is up 5 cents at 24.81. The high's been 95, as you can see, just below 95 in the low 68. The stock market, yes, we've seen a pretty good rebound in the stock market in the last few weeks. We're very close to being unchanged for the year, but I'm not too sure they'll be able to keep paper assets up elevated for that much longer. And I don't include commodities and miners in that category, of course. They have been outperforming year to date. I think this could be an end of quarter rally, and things will revert back to normal, I think, in terms of what's been happening this year. The NASDAQ is down a third, as you can see here, down 55. The Dow is down a quarter. Still fairly quiet this morning here. And the S&P is down 1/3%. FTSE is up a quarter. And the Euro Stocks is down almost 1%, actually, at 39.69. To the currencies, sterling is up 0.2 at 131.21. The euro is up over a third at 111.25. Very volatile, the dollar versus the yen. On Monday, the dollar got up to 125. Now we're down to 121.80. So a lot of volatility there. That's an important component of what's going on in the world. We spoke about that yesterday. We moved now to the yuan. The yuan, well, the dollar is down 0.2 versus the yuan at 6.36. And the dollar is also down a third versus the Swiss franc, as you can see here, 92.82. To the other currencies, Aussie dollar is unchanged virtually, 75.11. The dollar is down just under 0.2 versus the Canadian dollar at 124.80. And the Kiwi dollar is up a third, actually, at 69.58. To the commodities, WTI crude is up 2%, 105.70. Brent crude is up 1.75%, 109.65. So commodities, as I said, they're going to keep coming back. It's buy the dip commodities. And I think it's going to be for a few years yet, that kind of strategy. High grade copper up 1.6% at 481, and US nat gas up 1% as well. We'll finish off by looking at the 10-year yield and the US Treasury market, which basically trades almost 24/7 around the world. So the 2-year yield is down 2.3 basis points, just below 233, and the 10-year is down 1.5 at 238. So the curve inverted yesterday briefly. It's now there's a spread there right now. It's not inverted, as you can see. It's 6 basis points positive, but I think the trend will continue. As you can see, from 3s, 5s, and 7s to the 10s, they're all inverted. I think it's just a matter of time until this becomes permanently inverted. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.